Welcome to vTalkInsight, Risk Sentiment Daily for December 9th, 2025. With markets hovering near record levels ahead of a pivotal Federal Reserve decision and an AI-driven investment boom colliding with stubbornly high yields, today is all about whether this risk-on backdrop can withstand growing late-cycle pressures. Across global markets, the mood today remains cautiously risk-on. Equities are trading close to recent highs, with futures pointing to gains for a potential third consecutive week, helped by expectations of a near-certain quarter-point Fed cut and ongoing earnings upgrades. Volatility, while off the lows, is still contained in the mid-teens, signaling that investors are willing to carry equity and credit risk into this week's policy events. The backbone of this positive tone is a powerful mix of Fed easing expectations, robust earnings projections, and an AI-led investment story. Markets assign well over an 80% probability to a 25 basis point cut this week, and many desks are looking for a total of about 75 basis points of easing over the fall, with more than 80 central banks globally expected to reduce rates into 2026. At the same time, consensus calls for 9 to 10% earnings growth next year and even double-digit gains into 2026, helped by AI infrastructure, reshoring, and sector rotation beyond the largest tech names. However, the backdrop is clearly more fragile than the index levels suggest. Long-term Treasury yields remain elevated on the back of rising term premia and heavy issuance, while inflation is still running around 3% and key survey measures of expectations remain above target. Valuations are rich, credit spreads are tight, and the Federal Reserve faces its most divided policy environment in decades, all of which means that any policy surprise or data miss could quickly tilt sentiment from cautiously risk-on to decisively risk-off. Fed rate cuts and global easing remain the dominant bullish driver for risk assets. Markets are pricing an 80 to over 90% probability of a 25 basis point Fed cut this week, a view that has been firmly in place since November. Recent moves in Treasury yields and the outperformance of risk assets such as the Russell 2000 underline how strongly this easing path is embedded in positioning. Beyond this meeting, investors are looking for around 75 basis points of cuts over the fall, with the Fed then proceeding cautiously and data-dependently. Globally, expectations for more than 80 central bank cuts into 2026, together with fiscal measures and potential tax reductions in the U.S., are seen as providing a broadly supportive backdrop for multi-asset portfolios. Historical patterns showing that equities often advance in the year after the Fed cuts near record highs are reinforcing the belief that policy can extend this cycle, even if volatility spikes around each decision. This easing narrative favors rate-sensitive sectors, small caps, and credit, while encouraging greater risk-taking in emerging markets and cyclical themes. However, because the initial cut is so fully priced, the risk-reward is asymmetric around this week's meeting. If the Fed were to hold, or if guidance sharply downplays the odds of additional easing, some estimates suggest the S&P 500 could fall 1 to 3%, and a more hawkish tone could also support the dollar even as front-end yields move lower. An AI-led investment boom and earnings upgrades form the second major bullish pillar. Artificial intelligence remains a central investment theme, with projections pointing to a potential 9 times increase in sector market capitalization by 2033 and an annual growth rate around 30%. This narrative is being backed by real capital. A multi-trillion-dollar AI capex wave spanning data centers, power infrastructure, networking, and specialized chips is already reshaping corporate investment plans. Deal activity is reinforcing that story. IBM's $11 billion acquisition of Confluent highlights how incumbents are racing to secure real-time data and AI infrastructure, while Broadcom's rally on news of custom chip work for Microsoft underlines the depth of demand beyond the usual mega-cap leaders. Across the market, M&A is expected to accelerate into next year, with forecasts that cumulative deal volumes tied to AI, defense, and healthcare could exceed the widely cited $1.5 trillion figure over the coming decade. Earnings expectations are responding accordingly. Analysts see 9 to 10% profit growth next year, 12 to 14% this year, and improving outlooks for small caps as AI and productivity-enhancing technologies diffuse into financials, industrials, and healthcare. Yet the boom is not uniform. Private markets show clear FOMO-driven behavior in AI. Early-stage venture valuations have pushed higher even as other segments cooled, and investors are increasingly favoring strategies with resilient cash flows to offset the risk that some AI bets fail to monetize on the expected timeline. Broad risk-on positioning and capital access provide the third key source of support. Major asset managers and Wall Street banks are openly positioned for risk-on strategies, with many expecting double-digit S and P 500 gains into 2026. Despite money market yields drifting below 4%, the anticipated wall of cash has not fully rotated, yet underlying demand for equities and credit is described as strong even without a wholesale shift out of cash. Crucially, capital markets remain highly accessible. Corporates find issuance windows open, with credit spreads tight and a resilient tone in both investment grade and high yield. Financial sector bonds are benefiting from deregulation and M&A trends, and some investors have moved down capital structures in issuers they know well to enhance carry, underscoring confidence in the ability of many companies to refinance and fund growth projects. This financing backdrop is mirrored in the real economy. JP Morgan's plan to deploy $1.5 trillion in lending over the next decade into sectors such as security, defense, and critical minerals, together with strong trade flows through the Port of Los Angeles and record copper prices linked to AI and the energy transition, all point to healthy underlying activity. That said, there are early warnings that liquidity may deteriorate next year as the pace of global rate cuts slows, and tight spreads mean that any shock could produce a sharper repricing than the calm surface currently suggests. On the bearish side, inflation, fiscal deficits, and higher yields are a central concern. Even as markets anticipate Fed cuts, long-term U.S. Treasury yields remain elevated, reflecting a rising term premium, persistent fiscal deficits, and a heavy supply pipeline from both the Treasury and corporate issuers. Commentary notes that despite the likely cut, 10-year yields may stay relatively stable, implying only limited relief for mortgage rates and other long-dated borrowing costs. Fiscal dynamics are doing little to ease those pressures. Persistent fiscal expansion, including high U.S. deficits and increased spending in Japan, is expected to keep upward pressure on inflation and complicate central bank decisions into 2026. Some observers warn that unsustainable government debt trajectories could eventually lead to debt monetization, supporting inflationary forces and encouraging demand for so-called anti-fiat trades. For markets, this backdrop raises the hurdle rate for risk assets. Higher real and nominal yields squeeze valuation room for equities, particularly long-duration growth names, and leave little cushion for credit in the event of negative surprises. Rising home insurance costs, elevated copper prices driven by supply constraints and strong demand, and expectations of further rate-related pressures all point to inflation being slower to fade than the most optimistic scenarios, which could limit how far and how fast central banks are willing to ease. Fed policy uncertainty and the risk of a hawkish cut represent another important downside driver. The upcoming decision is widely expected to deliver a quarter-point cut, but commentary highlights that this could be one of the most divided meetings in decades. Estimates point to an unusually high number of dissenting votes, potentially up to 5, reflecting sharp internal disagreements over whether downside labor risks or upside inflation risks should dominate the reaction function. Markets are therefore focused less on the cut itself and more on the tone of the statement, the dot plot, and the press conference. Several voices expect a hawkish flavor to the cut, with explicit guidance that further moves will be cautious and strictly data-dependent, and that current 3% inflation leaves little room for an aggressive easing cycle. Unchanged but elevated inflation expectations, plus uncertainty created by delayed data releases after recent government shutdowns, add to the risk that the Fed signals a slower and shallower path than what futures currently imply. For markets, that creates clear two-way risk around this week's announcement. If the cut does not materialize, Some expect equity indices could fall 1 to 3% given stretched valuations and crowded positioning in a bull market built on easing hopes. Even with a cut, a hawkish message, questions about future leadership, or signs that the committee remains deeply split could drive volatility in front-end rates, FX, and equity multiples as investors reassess how much policy help is really coming. The final major headwind is the combination of valuations, concentration, and credit market fragility. The so-called Magnificent Seven tech names now account for roughly 45% of S&P 500 market capitalization, yet their earnings contribution has not kept pace, raising concerns about stretched multiples and concentration risk. Investors are already rotating toward sectors such as energy, financials, and consumer staples, and many are being advised to temper return expectations for 2026 after 2 years of strong equity and fixed income performance. Credit markets tell a similar late-cycle story. Spreads are tight, particularly in high yield, with some describing conditions as priced for perfection and leaving little room for further tightening. At the same time, the private credit boom is raising flags, especially for insurers and pensions heavily exposed to less transparent structures, and reliance on credit ratings without independent analysis is highlighted as a growing vulnerability should the cycle turn. Outside traditional credit, pockets of speculative excess are also visible. Crypto markets have seen single-day liquidations exceeding $19 billion, yet substantial leverage remains, illustrating how easily volatility in one corner of the market can spill over when conditions tighten. With liquidity expected to fade somewhat next year as global rate cuts slow, and with more emphasis on issuer and sector dispersion, this combination of rich valuations, concentrated leadership, and leveraged balance sheets suggests that selectivity and risk budgeting will be increasingly important in navigating the next phase of the cycle. To sum up, risk sentiment remains cautiously risk-on, underpinned by expectations for Fed rate cuts, a powerful AI-driven investment cycle, and broad risk-on positioning supported by easy access to capital. Offsetting that, persistent inflation and fiscal deficits are keeping long-term yields elevated, Fed policy signals are unusually uncertain, and stretched valuations across equities and credit point to rising late-cycle fragility. Watching how this week's Fed communication lands, how long-end yields absorb heavy supply, and how earnings and AI monetization evolve will be critical for understanding whether this bull phase can extend or whether volatility begins to dominate the narrative. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.